So with the trade conflict renewing this week, we've certainly been hearing from a lot of investors about how they're feeling about the situation. We certainly at 10 Capital care about your feelings. Your mother cares about your feelings. Hint, it's Mother's Day this weekend. But the market does not care about your feelings. So this week, we're going to talk about this unfeeling monster that is the market and what you might be able to expect moving forward. So as we talked about in the intro, it's been a tough week for people, inspiring all sorts of feelings. We care about your feelings here at 10 Capital, but the markets do not care about your feelings. In fact, there's an old saying, the markets will do whatever will hurt the most people. And after last Friday's all-time highs that had all-time lows in volatility, and all-time lows in terms of contracts, betting on volatility. The thing that was going to hurt the most people this week was a tough week, and that's what we got. That being said, it doesn't have to be that way. If you're anchoring, to harken back to the piece we did a few weeks ago, to last Friday's highs, then yeah, this week was a little bit disappointing with U.S. markets dropping 2%. What if your anchor, though, was December 24th of last year? Not only was it cold and snowy and now it's sunny outside, but your U.S. stock portion of your portfolio is probably up more than 20%. The point being here is most of our habits are to try to anchor to those all-time highs in our portfolio or in the stock markets. But just picking those arbitrary things, not only does it not help your plan, but it's probably going to lead most of the time to a pretty dark mindset with respect to the progress you're making that doesn't actually reflect reality. So we just encourage you to let that go. Know again that market movements like we had last week or this week don't have to impact your long-term financial success, and nor do you have to wear that pressure of trying to interpret news data all the time in terms of the market directions. And to that end, again, we'd harken back to another piece we did last June that looked at two studies. We'll put the link in below here that have been done looking at multi-decades. And the actual fact is, if you had the news, this is what they were looking at, ahead of time, more times than not, you would guess wrong to how the market was actually going to respond to that news. And there was a very low correlation, both studies found, between surprise news events, headline news, political surprises, and how markets reacted. And in fact, even in hindsight, you could only explain about a fifth of market moves based off those headline facts. And if you looked at just today, you had the tariffs come into effect at 12:01 a.m. I think if you had that news a week ago, you would assume the market would probably been down more than 2%. But even just today, how did the market respond to all that? It actually went up a little bit, about 40 basis points, 0.4% here in the U.S., 0.7% in international stocks. But what could be the impacts of these news? Well, if you listen to the talking heads on television, they're back and forth, the recessionary fearmongers. Yes, a recession will happen. I heard some guy pontificating the other day on CNBC, and he's like, I'm not calling for it now, but it'll happen eventually. Well, thanks, buddy. You know, it's going to rain again. It's going to snow again. We're going to have a recession again. The Cleveland Browns could theoretically win a Super Bowl this year, but I'm not going to go about betting my financial well-being on any of those things, and neither should you. You might think back to, again, that dreaded government shutdown that was going to end the world earlier this year and lead to global catastrophe. That came up this morning. I had forgotten it even happened, to be honest. It's just outside of my purview, and I bet that's the same for many of you. The current reality is quite different than what you're hearing. As fate would have it, we had trade data come out this week, and it looks really good. Exports to China almost jumped by over 20%. Total trade is only off the all-time highs from last October by 0.8%. And keep in mind, this conflict's been going on for some time. There have been 10% tariffs. For those who say, yeah, but what next? If you look at total consumer discretionary spending, which the economists at First Trust did this week, last year was $14 trillion. So these increased tariffs that came into effect today, if they lasted for a full calendar year, would amount to $30 billion. Admittedly, $30 billion is a lot of money. But in the context of $14 trillion, it turns out it's about 0.2%, which is hardly going to rock the U.S. economy and throw it into a recession. Similarly, the IMF came out and thought it would be about a 0.2% hit to GDP. Again, the most recent GDP report being well over 3% in the most recent reading. For those, if you've come across these lazy thinkers on television that are trying to spin the fact that China's been a country for far longer than us, and therefore they're more patient and can wait us out, and it's all about Trump's election next year, it really is a lazy thought that doesn't take into account how global business actually works. Got to read some really great reports this week. Heard a couple different speakers on the same subject talking about how you're already seeing businesses moving around supply channels, building manufacturing in other countries. These are not short-term trends. If China doesn't get this fixed, there's a very real threat, and believe me, they know that what their economy, at least for the time being, thrives on, which is manufacturing and exports, could start trending away from them in a way that has serious impacts. And those plans, the big speeches they were making a couple years ago on their 10, 20, 30-year vision, could get impacted in a very, very real way in what happens over just even the next 1 or 2 years should this play out. So this is as myopic as we all love to be here in the U.S. around the election cycle. There's a much bigger picture here going on that, again, both sides are aware of. Both sides have a lot of incentive to get this deal done. And when we listen to those people who aren't trying to sell newsletters or boxes of gold after they've scared you out, most of them still feel a very high probability that this gets done this year, and so do we. In conclusion, what do we want you to take away from this? Just like you shouldn't have chased stocks into the all-time highs last week on the euphoria feeling that such markets can induce, don't let this week's markets get you down too much either. Relieve yourself of some of that pressure. Remember again that this headline news that you feel this need to digest and make actionable decisions on is not actually good for that. The statistics, the facts are that it's just not possible. So this week, enjoy the sunshine. Remember to call mom. And to the degree you want to focus on your portfolio, think again about that long-term plan that you're mapping to. Thanks so much.